Hello and welcome everyone to the first panel discussion of day 2 of the Reimagining Climate Adaptation Summit. My name is Dr. Taryn Laubenstein and I'm a Research and Policy Officer at Future Earth Australia here in Canberra. We have people from all over the world joining us today, so I'd like to open up the webinar by taking a moment to acknowledge traditional owners from all around Australia and wherever you may be. For us here at the Academy of Science, we're on Ngunnawal country and we pay our respects to their elders past and present. I hope you all had the chance to see the excellent opening plenary this morning by Dr. Marcelo Mena Carrasco, which set the scene for our discussions today. Now we have an excellent lineup of panelists who will offer a range of perspectives on enabling action for adaptation to climate change. Specifically, this session is going to explore questions like who finances which aspects of climate across Oceania, how can we ensure just and fair adaptation, and how can we avoid maladaptation given the cascading climate-related risks that face our region. These are a few of the themes that we're going to explore today. So without further ado, I will quickly introduce our panelists. Crystal Fleming is the General Manager at the Investor Group on Climate Change, where she oversees the organization's ongoing operations and has lead responsibility for development and implementation of IGCC's Climate Change Adaptation and Resilience stream of work. Crystal managed the early establishment of the Carbon Disclosure Project in Australia and New Zealand. Zoe Whitton is an executive director of Pollination Group in Sydney, advising corporates and institutional investors on climate change and the energy transition. Zoe previously led Citi's APAC ESG research team, covered ESG and climate change for CS and BAML, and worked in management consulting with Port Jackson Partners. Zoe serves on the boards of the Investor Group on Climate Change and the Center for Policy Development. Dr. Ian Fry is an international environmental law and policy expert. His focus is currently on the carbon markets under the Paris Agreement. He was formerly the ambassador for climate change and environment for the government of Tuvalu and worked for the Tuvalu government for the last 21 years. And Chris Croker is managing director and one of the founding partners of Impact Investment Partners. Impact IP assists Aboriginal and Torres Strait Islander communities to better share in the economic and business opportunities on their land or in their communities through linking them with investors. Chris is an experienced senior manager, having worked across the impact investment, mining, and electricity industries. So thank you all so much for joining us here today. I'm looking forward to an interesting conversation. So first, we will hear from each of our panelists for 10 minutes each, and then we will have a discussion among our speakers. So with that, I will hand over to our first speaker, who is going to be Crystal Fleming. Thank you so much, Crystal.
Thank you. And I believe somebody is just putting up some slides for me. So I'm the General Manager of IGCC, which is a not-for-profit industry association, essentially a collaboration of institutional investors focused on the investment implications of climate change. And we currently have over 80 members, which include superannuation funds, asset managers, sovereign wealth funds and advisors who collectively manage over $2 trillion in funds. And IGCC members themselves, in the sense of beneficiaries, cover over 7.5 million people in Australia. And I guess I want to talk about the power of that private sector investment. And I was much inspired by the talks that I listened to yesterday. I myself come from a humanities background. I did an undergraduate degree in gender studies at Sydney University. And I always wondered how the degree in gender studies and psychology that I ended up working in climate change in finance. But I went to a talk of David Schlossberg a number of years ago, and it suddenly clicked when I saw the same social theories we talked about in gender studies that were being applied to sustainability, which were theories of embodied history and embodied environment, that we are literally part of the food chain and all that goes into it. And theories of power, both figurative and literal, and both can be either centralized or distributed. And that power is indeed diffuse and it is bottom up, but it is also top down. Not just political power. I think we're really seeing leadership on climate change really being driven by the business sector. But institutional investors themselves sit at the top of that investment chain, and they, in a sense, are the change enablers. But we ourselves, and that's you and I and the 7.5 million people fortunate enough to have a compulsory superannuation system, which in fact Australia is the 4th largest of in the world, we're part of that chain as well. And we also have input on where that $2 trillion goes. And those investors are readily embracing the need to consider broader impacts that investments have on society and the environment as a whole. Climate change really has two sides: the risk it poses and the investment potential it represents. Institutional investors have systemic exposure to climate change risks. The economic impacts of climate change are material to the investment returns of long-term asset owners and their beneficiaries, which in a sense is you and I. Climate change can indirectly impact the finance system through the consequence of extreme weather on property, infrastructure, agricultural production, and other climate-dependent industries. But it will also have indirect impacts on sovereign credit risks, supply chains, the property market, insurance pricing, or wider economic conditions. As such, institutional investors must consider climate risks as part of their fiduciary duty to members. But globally, investors also have trillions of dollars of capital to deploy towards climate change solutions if the policy and investment settings to support this investment are right. This private capital will be critical to climate change resilience measures, particularly as governments are likely to be fiscally constrained for some time due to the impacts of COVID. Having lived through a year of the global pandemic and coming off the back of Australia's unprecedented bushfires, we've experienced what might be most analogous to a wide-scale climate catastrophe. We've seen what that could look like, and I think we understand more than ever the need for resilience. $100 billion in insurance losses, though this only represents a small part of the picture, as most businesses are not insured for pandemic risks. But more than that, COVID reshaped our economies and the way we live. Governments are now pouring tens of trillions of dollars globally into the COVID recovery. And there are calls around the world, as Marcelo detailed, that this needs to be a green recovery and that infrastructure and all that's built in it needs to be resilient. With such mass governance stimulus and trillions of dollars of infrastructure spending brought forward, this is a critical period of time as the window for getting climate change right has shortened. We can either lock more brown infrastructure in or we can make that green. But there's also the risk of maladaptation. Essentially, we can't afford to solve yesterday's problems. We have to use that money to solve tomorrow's. Global building stock is set to double to 215 billion square metres by 2050. All of this will need to be net zero, and it will need to be climate resilient. A third of the infrastructure necessary in cities and emerging markets has not yet been built. Factoring in resilience to that infrastructure will be critical. Well, what's the size of the challenge? According to the UN Environmental Programme, in developing countries alone, adapting to climate change will require between 280 and 500 billion US a year by 2050. And recent tracking of public finance adaptation flows shows that less than 10% has been invested. Though I would say that private adaptation finance has been little tracked because it's very difficult to actually do so. This represents an enormous adaptation finance gap, but also an enormous investment opportunity. In Australia, federal and state governments currently spend an average of $2.75 billion a year on direct recovery from disasters, compared to funding for national disaster resilience of approximately $100 million a year. The total economic cost of natural disasters in Australia is expected to rise to $39 billion by 2050. With a 6-to-1 benefit-cost ratio, investment in resilience is far more cost-effective than funding disaster recovery. But governments alone can't foot this bill, and we need private sector capital into climate solutions. And I would say, fortunately, capital is moving. At IGCC, we surveyed our members last September and found that even in the midst of COVID-19, appetite for climate-aligned and net zero investment continued to be strong across all regions and asset classes. COVID-19, in fact, seemed to have been a catalyzing event to show how institutional investors are connected to the real economy. And surprisingly, COVID-19 had minimal impact on investor action on climate change. Investors were simply getting on with it. We're seeing net zero targets become the norm. And climate change is shifting out of socially responsible investment options and becoming entrenched in portfolio-wide investment strategies. And we're seeing a shift from using methodologies purely for integrating and benchmarking of ESG towards defining how investments benefit broader society. Whereas much of this investment has been focused on greenhouse gas reduction, investors are also looking across their portfolios and asset by asset, undertaking physical climate risk assessments and implementing adaptation responses. As investors understand that climate resilience is not something that to think about in decades into the future, but the climate risks are playing out now. Sophisticated investment tools are rapidly emerging to strengthen the resilience of infrastructure, the economy, and the communities, though the legal and regulatory requirements for private sector actions to do so are limited or weak. Much of this is done on a voluntary basis or in response to signals emerging from the legal interpretation of directors' duties or fiduciary obligations. Currently, the risks of physical climate impacts are not properly priced into asset valuation considerations or investment decisions because the systems we have don't adequately address climate risk. Properly pricing climate risk in financial decision-making would align investment flows towards resilient infrastructure and drive a shift toward a more resilient climate economy. And I wanted to give you an example of some of the work emerging this year on this front. And if I can ask you, Eleanor, to go to the next slide. I heard a call yesterday for the need to embed the human in the non-human. And I would say that this graph is what this looks like in the financial sector, where in order to do this, we have to be able to quantify it. How do you go about valuing resilience? Essentially, how do you place a value on something not happening? How do you invest in that avoidance? And how do you derive a return? And who ultimately pays for it? And this is where we're seeing exciting changes to the system and interesting frameworks emerge. This graph you can see here is one of these. This is the Coalition on Climate Resilient Investment, which is a flagship COP26 initiative. It's led by 70 private sector organizations, which include banks, insurers, rating agencies, multi-development banks, and governments, representing $11 trillion US in assets, who are all committed to the development and testing of solutions for climate resilient decision-making and overcoming the mispricing of physical climate risk. And excitedly, I would say that, let you know that IGCC is a member of this, but also Australia has joined this coalition. And it will be actively involved in developing some of these methodologies and some of these tools that will come out of this initiative. You'll forgive me on the timing here. This is a little bit out of date. I don't have an update, but you can see here that there are a number of things that are meant to come out of this initiative this year, which will be tied in with global events happening. But the first of those is a cash flow modelling framework, and this will actually specifically value resilience when looking at the cash flow modelling for an asset. The next exciting one is a assessment tool for addressing systemic risk in countries. So this is actually being piloted now across Jamaica, and it's being used for countries to be able to prioritise their investment in adaptation on a widespread scale. And we're also looking at taxonomies for innovative finance mechanisms like resilience bonds. So I would say watch this space. This will be an exciting initiative to come out this, or actions to come out of this initiative this year. But I'd also say that understanding and better pricing this risk will also advance the case for mitigation by better understanding the cost of inefficient action. So just following on from Marcelo's point a little bit earlier, in terms of what else we need. I heard a call yesterday for transformational national adaptation process. And I think this is something that we need across the globe. But I guess I'd ask in return these questions. Who's going to fund this? Where will we need the investment? What will it cost? What adaptation measures are going to provide the greatest amount of good? And what is the cost benefit? How do we derive a return, both financial and social and economical? And how do we leverage private sector capital to invest where there is a public good? These are questions that we are working on and still answering, but we need to be able to get more private sector capital into adaptation measures to affect wide-scale resilience. I'm a little out of time, but I just wanted to finish with one final point, which is that 2021 is really expected to be a catalytic year for resilience. I think it's a year that we finally put resilience on par with mitigation, and especially in the lead up to COP26. So I would say, let's use this year wisely to catalyse action and implementation. Thank you.
Thank you so much, Crystal. What a wonderful talk and call to action. Now we're going to turn to our second speaker, Zoe Whitton, the Executive Director of the Pollination Group in Sydney and board member of the Investor Group on Climate Change and the Centre for Policy Development. Thank you so much, Zoe.
Hi, everyone. I am just sharing a screen with you so that you can see what I'm talking about. Taryn, can you turn your video on and give me a thumbs up? Just let me know you can see that. Fantastic. Okay, hi everyone. I'm going to try and go under time. So I'll have a lot less to say than Crystal, I think. So let's see how we go. Particularly what I'm going to talk about today is Crystal was starting to dig into the question of what are the challenges now that we start to think about investment in this space, and who's going to do it, and what kind of tools do they need to do that. So that's really where I'm going to lean in here. And some of you will know that, on the call that my background is in institutional finance. So we're talking large asset managers, large institutional sovereign investors, asset owners, large banks, and these types of other financial institutions and insurers. And you could see that coming through the conversation that what I'm about to talk about as far as private investment versus public investment. But if you do see that leading, please do not think that it's because that's the only important part of this conversation. Crystal and I both work very heavily in the institutional finance space, but it's not the only piece of this. And I'm sure that Ian will have a lot to say on the public financing space when I'm finished. So without further ado, let me just select this and make sure that we're actually paging through. Here we go. So as Crystal has sort of outlined, and I just want to go into a bit more depth, adaptation financing is basically the lesser understood sibling of transition finance. So many of you will be familiar with a lot of the conversations that we have on the transition side of finance. We talk about grid decarbonization, we talk about electrification, efficiency, and we have other emissions abatement activities that we do across system as well. And we have a huge number of institutions, standards, processes, targets that we use in that space in order to govern our investment in transition finance. And there's quite a lot of it as well. Many of you will have heard of the TCFD, the Task Force for Climate Related Financial Disclosures. How quickly can you say it? Can you say it several times? And the TCFD is one of the big structures, big frameworks that we use for transition investment particularly. So there's a lot of development that's happened in that space. But adaptation finance is the other half of it. And here we're talking about both sometimes a broader set of investment activities, but also a set of investment activities that are mixed in their characterization. And I'll get to that. But we're talking not just resilient infrastructure, but also industry, property, supply chains, disaster response, and also migration and community reconstruction eventually. And the investment that we're thinking about there is across the public space, and Ian will talk more about that. There's quite a lot of development there. It's also in the direct private space, and there's quite a bit of work that's been done with respect to individual project investment there and bond structures, but it is also about investing in a resilient way, as Krista was saying, across everything that we do. And so it's a lot about standards, and I'll get to that. But the point that I want people to take away from this slide is that on the transition side, a lot of that is quite well developed. On the adaptation side, we're really just coming up the curve. There's a huge amount of work. It will probably happen faster than it did on transition, but nonetheless, there's a lot of development that is yet to happen in that space. Now, this is just a diagram of something that Crystal spoke about, which is the volume of finance. This is adaptation finance. Well, actually, sorry, this is climate finance. As of 2018, I believe. This is the map. There's a yearly review that gets done, which sort of turns into this Sankey diagram. And you can see, particularly if you go 3 columns across to uses, you can see that adaptation is a little box at the top with the $30 billion in it, and transition is down the bottom with everything else. And so that kind of gives you a picture of that volumetric story, which is at the moment, we're doing a huge amount of investment in transition. We need to do a lot more, but we're still doing quite a bit. but adaptation really hasn't quite got off the ground yet. And there is a subtlety there, which Crystal touched on, which is that adaptation finance is hard to track. So there could be a lot happening that we can't see. But nonetheless, if that adaptation financing is to get to between 140 bill and 300 bill in 10 years, or as Crystal was saying, up to 500 bill by 2050, there's a really, really quite significant growth pathway there. And the other thing to take from this slide is just to see how much of that adaptation finance is coming from public sector as opposed to private. So public's up the top in blue, private's down the bottom in orange. And if you look at those gray flow diagrams, you can see that the vast majority of the adaptation financing that's happening now is happening in the public sphere. Now, I want to talk a little bit more about this because across, we can categorize this investment by a few different categories. We can say that we can make direct investments in projects or infrastructure. We can say that we can change standards across all of our investing activity, or that we can provide financial assistance. And those three categories are relevant for both transition investments and adaptation investments. But we see different entities acting in different parts of that system. So for example, on the transition side, a huge amount of private investment is happening in the direct investment space. Renewables investment is a really good example of that. There's also a really heavy use of standards in private investment for transition, which we spoke about before. Net zero targets, TCFD, this type of stuff. As far as assistance, direct assistance goes, it's much less of a private sector piece on the transition side. And although the private sector is starting to think about just transitions, the capital allocation is not something that we're really seeing yet. Now, when we move over to the adaptation side, we get a bit of a different mix. And as far as we see investors acting now, and we do speak to a lot of different investors, we see that most of our adaptation financing, which is private, is happening on a project by project basis. We're beginning to see the development of things like the CCRI, and to a lesser extent, things like the Task Force for Nature-related Financial Disclosures, which will have an adaptation lens over the top of it. But as far as adaptation standards go across public private investments, there's not that much happening there. And then the final piece is that disaster resilience and recovery finance, which is well developed on the public side, but really is outside of the mind of the private space. Now, I just want to make one more point here before I pass you on to our next speaker. There are a number of really acute challenges that come up with adaptation financing that is immaterially additional, let's say, to transition financing. And I've got three on the page here, but the overarching problem here is about interaction. And so investors are generally used to thinking about their investments in an atomistic way. You know, I have this project, it gives me this return. I own this company, it gives me these earnings. And you make portfolios out of a whole bunch of atomistic pieces. Now, for many of you in the adaptation space, that will set alarm bells off almost immediately. And of course, that is because a lot of adaptation and a lot of resilience is about interaction across systems, interaction across assets, and from the investment perspective, interactions across different investments. And investors are, at the moment, not particularly well set up to think about those types of interactions. And so we have interaction between one investment and another in an individual space. We have interactions between what we call asset classes, so between maybe my debt portfolio and my equities portfolio. And then we have this question that Crystal raised, which is about accounting for avoided damages as opposed to income. So we're used to accounting in terms of a project and what it produces. We're not used to accounting for a project and what it has avoided from happening somewhere else, what volatility it has reduced, what resilience it has lent. So there are a whole series of tools, which I won't go into in this particular conversation because I'm about to run out of time, that we can think about introducing to start thinking across portfolios, but it's really, really, really early days for this type of thinking about interaction. And so probably the takeaway point that I would say here is that as we go into adaptation financing, particularly as we go into adaptation financing in the private space, the investment industry is having to change the way it thinks, and it's having to think about interaction and system effects more than it's ever had to before. And that's a whole journey of intellectual development that I am going to leave our other panelists to speak about, and we'll probably talk about it in the Q&A as well. And thank you so much for having me.
Fantastic. Thank you so much, Zoe. And it sounds like there's some very interesting early days things that we can discuss maybe later on during our chat. Next up, we're going to hear from Dr. Ian Fry, who's an international environmental law and policy expert, and former ambassador of climate change and environment for the government of Tuvalu. Thank you so much, Ian.
Thank you very much. And listening to the previous speakers, I wanted to sort of follow in that theme. And I want to talk about climate change financial risk and the need to disclose such risks. Ostensibly, there are three types of climate financial risk. Type 1 is exposure to financial risk due to the impacts of climate change. Type 2 is exposure to financial risk from investment in high greenhouse gas emitting technologies and practices. And type 3 is exposure to litigation risk due to the lack of action on types 1 and 2. I'm going to focus on type 1, the exposure to financial risk due to the impacts of climate change and the need for disclosure relating to that risk. My interest in this area comes from being part of a group developing a Pacific Island climate change insurance facility, which will hopefully include a climate change risk disclosure facility. So last week, the Democrats in the United States reintroduced the Climate Risk Disclosure Act. The bill will require public companies to make disclosures about their exposure to climate-related risks. The bill will direct the Securities and Exchange Commission to require firms issuing securities to make disclosure on an annual basis. One of the disclosures requires information on how their valuation would be affected under various climate change scenarios. Furthermore, President Joe Biden has prepared a draft executive order titled Climate-Related Financial Risk to instruct federal agencies to take sweeping action to combat climate-related financial risks to government and the economy. Meanwhile, in Australia, there has been some progress, as we've heard from previous speakers, in climate change financial risk disclosure. The Australian Securities Investment Commission updated its regulatory guide 247 to highlight climate risk as a systemic risk that could impact on entities' financial prospects for future years, and that may need to be disclosed in operating and financial review. In 2019, the Australian Prudential Regulatory Authority announced that it would increase its scrutiny of how banks, insurers and superannuation trustees are managing the financial risks of climate change to their business. APRA encourages the adoption of voluntary frameworks such as the Financial Stability Task Force on Climate-Related Financial Disclosures, TCFD, as we've heard from previous speakers. The ASX Corporate Governance Council has also recently issued guidance in the importance of climate change risk disclosure, encourages consideration of the Task Force on Climate-Related Financial Disclosures. The Australian Accounting Standard Board and the Auditing and Assurance Standards Board released guidance on climate-related and other emerging risk disclosures. Further, a group of experts in the field of sustainability have created the Australian Sustainable Finance Initiative to develop a sustainable finance roadmap. Generally, however, all these domestic measures are voluntary and the take-up is reasonably slow. An ASIC study in 2018 found that only 17% of listed companies in their sample identified climate risk as a material risk in their operating and financial reviews. They did find, however, that a majority of ASX 100 companies had, to some extent, considered climate risk to the company's business, and that there is limited climate risk-related disclosure outside of the ASX 200. So there are certainly deficiencies there. And various studies by accountancy firms in Australia have confirmed these sorts of findings. Currently, the New Zealand government and the UK governments are looking at developing climate change risk disclosure legislation. Hopefully, the Australian government will see the light and develop such legislation. But I have to admit, I'm not holding my breath over that fact. So why is climate change risk disclosure important? If companies realise that they are exposed to financial risks due to the impacts of climate change, they can do two things. One, they can walk away from the risk, or two, they can invest in risk reduction and adaptation strategies. And as we heard from the previous speakers, hopefully they will do the latter. Finally, climate change risk disclosure should not be just a requirement of large corporations. All levels of government and other levels of business must also disclose their risk to climate change impacts and respond adequately to those risks. We only need to look at some of the highly exposed risk areas in Australia, such as the Gold Coast and its canal estates, to realise that these developments are disasters waiting to happen. The tourism industry is already experiencing a disaster with coral bleaching on the Great Barrier Reef. Meanwhile, we continue to see enhanced climate change related risks of droughts, bushfires and floods throughout Australia. If climate change financial risk disclosure is not dramatically ramped up and made mandatory, we may see a significant rise in type 3 financial risk, exposure to litigation. Thank you.
Fantastic. Thank you so much, Ian. And for our final presentation, before we begin our group discussion, we have Chris Croker, Managing Director and one of the founding partners of Impact Investment Partners. Thank you so much, Chris.
Hi, everyone. My name is Christopher. I'd like to pay my respects to traditional owners across the country. I'm in Melbourne, so the Wurundjeri people of the Kulin Nation. I pay my respects and would like to say Wamanjenka to all fellow Aboriginal and Torres Strait Islanders on the call. I'll just share my screen. So hopefully that's sharing. Thanks, Tanya. Hi, Taryn, sorry. I'd like to build on this idea of risk and risk mitigation, but from an Indigenous perspective. Three key areas that I'd like to talk about today are, as it shows on the screen, First Nations people have a very powerful role, but that role needs to be respected. Traditional or First Nation knowledge can really help communities adapt to changing climates, so manage some of the risks and adaptation needs going forward. And thirdly, First Nations people in Australia and around the world actually can play a really meaningful role in managing and even financing some of the climate adaptation that's needed, but they need to be included in the conversation. Building on the first point, the role of First Nation people, in many countries, particularly in Australia, Aboriginal and Torres Strait Islanders are on the front line of feeling the effects of climate change. Recently, the Australian CSIRO modelled, the effect of climate change into a town like Alice Springs in the Northern Territory. I should have pointed out, sorry. So my family are Luritja from the Central Desert. So I know, the desert communities very well. And, it's a discussion that we actually have in everyday life now, the changing climate, the changing weather patterns. And this was reinforced by the CSIRO, where they're basically saying that over the next 20 to 30 years, there will be a doubling of the number of days experienced in Alice Springs that are over 35 degrees, and also the number of days in a year that are going to be above 40 degrees is going to is going to double and then double again to up to 70 days per year. That's compared to in recent recorded history, where the number of days above 40 degrees have actually been in the low teens, between 10 and 15 on average per year. This has a huge effect on a whole swag of social indicators and way of life for both the Aboriginal Torres Strait Island communities, but also the non-Indigenous members of Australian community that reside in these inland communities. Whether it affects the real estate value attached to these towns, children, are going to be more and more experience more and more extreme heat events. They're going to be discouraged from playing outside, attending school where the schools aren't air conditioned and cooled. And it's going to have a adverse effect on health. Many, with the ageing population, the number of times that health-related heat stress is going to be experienced across the country, particularly in the desert regions, is going to multiply. In the north, many may be familiar with the Torres Strait Islanders that occupy the small remote islands north of the Cape York, north of Queensland, between Papua New Guinea. And Torres Strait Islanders are the second group of Indigenous people to Australia. Many of their islands are low-lying. They are, within, 5 to 10 metres above sea level on average. As we experience more extreme weather events, coastal erosion, we currently see 17 inhabited islands in the Torres Strait Islanders are actually at threat today. Torres Strait Islanders openly talk about that their human rights are being violated by the lack of progress or adaptation by the Australian government. The human rights are being violated, and they're currently pursuing human rights violations in the UN Human Rights Committee in Geneva. We know that there's actually been a difficult history when we talk about Indigenous environmental relations in Australia. There's many times when environmental reform and protection measures have been at odds with Aboriginal rights and recognition. Internationally, we see that rather than having a difficult relationship between environmental reform and protection and adaptation and in Indigenous rights, there's actually a growing recognition that Indigenous rights and involvement in adaptation strategies and mitigation strategies are actually needed internationally. So the picture on the screen is showing the carbon storage potential across forests around the world, across the equator and tropical regions, where recently the Rights and Resources Initiatives and the WRI found that Indigenous people and local communities collectively manage a staggering 54 billion metric tonnes of carbon, above ground carbon, in terms of grasslands and forest assets around the world. That's a quarter of the total found above ground in all of the tropical and subtropical regions. what does 54 billion metric tons mean? That's the equivalent to 250 times to 350 times the global emissions from air travel per annum. Human rights, Indigenous forest rights are a good climate mitigation strategy. Where we can strengthen Indigenous forest rights or land rights anywhere, whether it's in Australia or internationally, that's going to help the struggle and mitigate some of the risks when it comes to climate adaptation. In a local context, many would be familiar with land rights, Aboriginal and Torres Strait Islander land rights, native title, the Mabo decision, native title for Indigenous groups across the country. What many won't be familiar with is this graphic shown on the map, whereby, so a little bit, a bit of explanation. The orange coloured areas on the map are land held in exclusive and freehold title by Aboriginal groups across the country. The blue is exclusive native title possession. So basically, local Aboriginal groups have exclusive use over all of their land. That's coloured blue. Yellow/orange, a lighter yellow or orange. Non-exclusive native title means where the native title rights of Aboriginal and Torres Strait Islander groups have been recognised in a court of law, and they have to be shared. Rights to that land are shared with other land users. In most cases, they are pastoralists. The light grey, which you would see covers almost all of the area that's not Aboriginal held, are currently registered native title claims. So these are parcels of land where local community groups have express their desire to exert their traditional rights over the use and management of that land. Collectively, Northern Australia, which of course covers most of our tropical and subtropical and savanna country, where the forest rights that I spoke about with the carbon mitigation strategies, 80% of Northern Australia has some type of exclusive position right with Aboriginal and Torres Strait Islanders. 40% are exclusive rights. The remainder are a shared right with other land owners across Australia as a whole. 80% is subject to either currently determined native title or is in the process of some type of native title claim. I want to just reflect on that a little bit, in that basically what does that mean? We're talking about a staggering amount of Australia's landmass and also coastal regions being Aboriginal, Torres Strait Islander controlled. If it's not currently determined through a native title process, then any type of carbon abatement, future reform work in those regions, actually community groups have a right to negotiate. Developers, whether they are public or private investors, need to negotiate with local land owners, traditional owners from the group, prior to developing any type of new projects, whether it's a green project or a traditional hard infrastructure project on those parcels of the country. So of course, Aboriginal, Torres Strait Islanders and First Nation people around the world are important stakeholders to help address some of the climate adaptation risks going forward. Sorry, just bring my screen back up.
Great. Thank you so much, Chris.
The other thing is that I wanted to quickly talk about is the role of traditional knowledge. Around the world, in Australia, there's growing evidence that the knowledge that First Nations groups have accumulated over many, many generations provide valuable lessons that can inform the discussion around climate adaptation going forward. In Australia, there's been recorded history and studies that have confirmed that many groups across Australia still actively remember, for an oral history point of view, still remember the last ice age and the receding sea levels that came about. Whether they are reflected in Chukaba, Dreamtime stories that are more mythological based, or actually more straight factual accounts, where in Melbourne, where I reside now, local Aboriginal groups actually tell stories. It's reflected in the oral history around the loss of kangaroo hunting grounds that took place as sea levels rose when the last ice age ended. Internationally, one of my friends is from Pakistan. They were telling me around their traditional knowledge around the changing seasons and the markers that come about through observing the moon and the star patterns are now currently actually informing the modern day harvest practices being used in Pakistan, because the traditional knowledge helps predict weather patterns and planning for harvest and the right time to raise livestock. That knowledge has been accumulating in Australia, of course, but internationally as well. But whether that's being used effectively and harnessed for this wider climate challenge that we have in front of us, I think there's still work to be done. In Australia, you may be familiar, the Bureau of Meteorology, of course, has been working with traditional Aboriginal groups for quite a few years now to capture some of that climate knowledge, whether it's seasonal or even a longer term climate pattern, to really reflect back into that, into that scientific knowledge base that we all need to build the baseline and get the right stories right to be able to plan for the next change that we have in front of us. The other thing, going back to that Aboriginal land ownership across Australia, which really reflects my third point, that First Nations people actually have a real opportunity to play a part in managing and also financing climate adaptation, but they need to be included in the conversation and the policy reform. In Australia, with that land ownership, our estimation at Impact Investment Partners is that Aboriginal and Torres Strait Islander groups currently manage over $10 billion of financial capital, and would be 40% of the Australian land mass. I don't know what price you would put on that or what asset value, but there's a lot of capital, land resources and local knowledge that can be mobilised to work with public and also private investors to help get the future strategy for Australia right. More than happy to take questions.
Great. Thank you so much, Christopher, and to all of our panelists for those presentations. So now we're going to have a bit of a group discussion. So we have about 15 minutes now and then another 15 for audience questions. So I'll add that you can put your questions into the Q&A box that you can click at the bottom of your screen, and we really appreciate those inputs. So I'll ask our panelists to turn on their videos so we can have a bit of a group discussion. And I'll start us off with one question, which is, are there opportunities for new adaptation economies? And if so, how can policy shape these to avoid maladaptation? So you can just call out as you wish.
Can I jump in on that one?
Absolutely.
I would say absolutely, and that's the challenge. Once we can get to the point of seeing adaptation as an investment opportunity, this is an enormous market area that we can actually tap into, and we can use that private sector and public sector capital to actually solve those solutions. We do need some policy solutions for that. So we need cooperation between different levels of government that have different responsibilities for funding adaptation and working out how local governments can borrow from state governments or federal government, but also bring in and be able to leverage private sector capital. So whether that's through public-private partnerships, whether it's through the creation of some of those innovative sort of finance mechanisms I talked about, bond structures and things like that. But there is an enormous market yet that we haven't yet seen developed.
Thank you, Crystal. Any other reflections?
Yeah, so I was just going to add a reflection on an area that I know from a practical point of view, and that's in the carbon markets and how it relates to Indigenous land. So you would know in recent years there's been a bit of a change in the type of carbon that can be, or carbon capture mechanisms that can be traded. And one of the areas that's is actually around the rehabilitation. So with human-induced carbon change or reforestation. And from a traditional point of view, from an Aboriginal point of view, it's actually kind of like a win-win. That it creates local jobs, land management and preservation, and also capturing more soil carbon being captured, which then can help address some of the issues. But the problem is that we have a massive headway happening with private investors who are seeing the economic potential, which is good, of course, but sometimes that huge economic drive is at the detriment of local groups, and there's actually limited coordination between the states. So as Crystal has said, more policy alignment, whether it's from the state or the feds, and how that ties in with international carbon markets, I think we're a long way from getting that sorted out. So we need more work.
Taryn, the other thing I would add, just on the question of maladaptation, which I think goes to Chris's point as well, when these things start to become an apparent economic opportunity, obviously the market tends to get involved, and then you can have a development pathway that's almost entirely determined by the economics, and when there isn't the policy infrastructure around it, sometimes the economics doesn't line up with the social outcomes or the environmental outcomes you'd want to see. And I think one of the things that I would flag on the investment side as being really important for avoiding maladaptation is getting climate risk and priced and visible in all the right places. So for example, at the moment, there is a general understanding among our large investors in Australia that if climate change happens, it'll be awful, be hugely expensive, and let's do mitigation instead. We're all doing mitigation, net zero targets, it's great. But the actual visibility about where that risk will hit, how painful it will be, which assets it will affect, how it will play out is fairly limited, actually. So even though there's that agreement that it's time to move, the visibility on the underlying risk profile is not great. And because of that, a lot of the work that will be done on adaptation, and there's some really good work being done on adaptation, but without that visibility, some of the work that's done on adaptation will flow down the most available pathways and use the most tractable approaches. And we won't necessarily know if that's addressing the real serious concentrations of underlying risk and if it's targeted and in the right way. So I would just flag that effort to what seems quite elementary and seems like something that we certainly were talking about in climate science and climate economics kind of 10, 15 years ago, that translation is yet to happen for the investment world in a really granular way. So getting that right, I think, will also help prevent getting maladaptation.
Perhaps I can come in just to talk about adaptation finance at the international level. I was part of a Zoom call with the UN Climate Convention last night, talking specifically about this issue and how we can tap into the carbon market to provide finance for adaptation. It's called the share of proceeds of the carbon market, and we're trying to work on the rules of that. There's certainly a significant pushback from some developed countries to not have a share of proceeds applied to the international trade market, which is called internationally transferred mitigation outcomes. And Australia is one of those. And I have to say Australia's approach to international adaptation finance is fairly poor. It's withdrawn its funding to the Green Climate Fund, and this is unfortunate. And the Green Climate Fund has a specific 50% of its window is for adaptation finance. So this is an issue. And of course, this share of proceeds from the carbon market goes to the Adaptation Fund. And the reason why that fund was established is because it creates autonomy over sourcing finance by highly vulnerable countries. And the reason this autonomy is that it's not donor driven, and the donors are not saying where the money should be spent, and that's critical. So we still have significant gaps and attitudes towards international adaptation finance. Thank you.
Great. Thank you, everyone, for those really insightful responses. And I think we have some really great audience questions now to respond to that should give us some great answers as well. So the first question I'm going to go to is from Gay Hawkins, who thanks you all for your talks and asks a question first to Chris and then to the rest of the panel. So first to Chris, who are the partner investors Impact are working with? What types of organizations are participating? And then a related question for the other presenters are, how much investment potential is out there for other sorts of impact investments, such as philanthropic or other forms, driven primarily by social and ecological returns, not standard measures of financial growth? So Chris, I turn first to you.
Well, that's a big question. So just speaking, so my group, so we launched the Indigenous Infrastructure Investment Fund almost 2 years ago now. The investors that we have on board come from two groups. Institutional investors, we all love institutional investors. They are large, they have structures that that you can work through, and then you understand what their desires are, and they're great partners to have on board. The other groups, of course, because we have a 100% Indigenous focus, are the Indigenous land trusts and foundations that I mentioned around the country that over the last 20 years have been slowly accumulating financial assets. We have many discussions with ESG aligned investors. Sometimes they are easy to deal with because there's a clear visibility of, there's a clear alignment of goals. Sometimes though, and this is maybe more around the metrics or the policy positioning, is a lot of ESG aligned investors already know what they want to invest in. So their mandates are quite narrow. So they're the ones that we're working with. We have spoken to a whole bunch of, we speak regularly with Impact Investments Australia, the lobby group for impact investing in Australia that, really wrote the white paper for the Australian government on impact investments. That's a growing market in Australia. And there is a growing understanding. Most people would say that it's the younger millennials that have a dual investment outlook on life. They also want to be make sure that we're not doing any harm, we're doing good for the future, and also we're making a return. Whether that's actually translates into that there's a trade-off, that's yet to be seen because, of course, that investor group is newer and growing, whereas most of the traditional wealth is still sitting with the institutional investors, which is actually coming from more mature age investors, and also the private funds as well. There's still a lot of work to be done. There's a lot of opportunity, and impact investment is not really understood in Australia. There's many terms, and I'm definitely not the expert to speak about it. Whether it started, ESG, socially aligned investments, impact investments, and really there's a bit of a misunderstanding of the degree of across the spectrum between social outcomes and financial, and where do you sit? We've mentioned a little bit before about the investing in climate markets or climate products, carbon markets and carbon products. And if you are purely doing it for the economical reasons, the financial reasons, that's good, but actually could lead to maladaptation or actually the wrong outcome socially. So there needs to be a bit more of a coordinated approach.
Thanks, Chris. Did our other panelists want to reflect on the second part of that question about how much investment potential is out there for other sorts of impact investments, such as philanthropic or other forms, driven primarily by social and ecological, not standard measures of financial growth?
I think the only comment I'd make on that is that generally the sizes of the investment markets are that the philanthropic investment compared to the size of the institutional investment market is quite small. It doesn't mean it's not impactful. It doesn't mean it's not important. It's quite a small section of the global capital market. And so there is, when you're thinking about getting access to further investment, there's always two pathways to doing so. One is that you have an approach which demonstrates against the impacts or the interests needed by a smaller group of investors, like philanthropic investors or foundations. And the other is that you change the preferences of the whole investment system. And it sort of depends what type of projects, what type of outcomes people are trying to raise finance for. And one of those approaches or the other will work for different types of outcomes. But generally the volume in the philanthropic market is quite limited compared to the volume of either international public finance or particularly institutional markets. But you use them for different things.
Fantastic. Thanks, Zoe. So I might turn to another question from the audience. This one from Mark. He asked, what research is needed to help progress the journey of finance industry as fast as possible with regard to challenges raised by Zoe, like modeling interactions credibly and valuing avoided risk?
I'll say something about this, and I'm sure others will have things to say as well. It's a really good question, and probably I would identify them probably as probably being two big types of research that are useful. One is that approaches to, and this is a bit esoteric for those of you who like to get into finance research, but approaches that allow investors, companies to think about resilience and to think about resilience across different assets or across different parts of a company, across different divisions, across different parts of an economy. Developing those types of approaches is really useful at this point, and we are doing research on that as well. Because in our investment arm, we undertake investments in real assets that generate resilience impacts and natural capital benefits or co-benefits. And so one of the things that we work on quite a lot is to think about, if I have them in one part of my investment portfolio, how does it relate to the rest of my investment portfolio? So that relationship effect is a really useful piece of, a really useful area of research at the moment. Another useful area of research I would highlight is one of the things that's been extremely useful for transition has been being able to say, look, if we have a successful transition, this is what the composition of the economy will look like in 5 years, in 10 years, and da, 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 da. And what we don't have on the adaptation side to the same extent, or at least we do have it in certain forums, but we don't have it in language or in a world that the financial sector understands, is a similar pathway for adaptation for resilience. To say, this is, if you are an investor, then by 2025, you need to have this much capital in something that is doing this, or all of your system needs to be at this level of resilience. And the fact that I don't even have a metric to say at this level of resilience is telling, right? Because I can say for transition, by 2025, you've got to have reduced your emissions by X across your portfolio. I've got a metric for that, but I don't have a metric for resilience. And so trying to build a resilience pathway or a scenario which then can be compared to the activity that investors undertaking at any given point in time, and they can say, yes, I'm on the right path, is a really useful question to answer. And I think to the extent that we can develop resilience pathways or resilience scenarios, scenarios makes more sense in the transition risk space, but to the extent that we can develop resilience pathways, they'd be quite useful for the financial sector and for commercial decision makers. Crystal, I don't know if you want to add to that.
Yeah, look, I would echo all of what Zoe just said. I think those metrics are really important to be able to define, what adaptation means, what resilience is, how do you actually quantify that, how do you actually value that, what level of adaptation are you aspiring to, and what is the actual metric for what that looks like. But we also in Australia don't even really understand properly what the cost of those physical impacts of climate change is. We're also always hearing that argument made about the cost of transition, but we don't really have the comparable figures on what the physical cost of climate change is, and therefore, the cost benefit of mitigating. And following on from that, I guess we don't have an understanding of how much is actually needed for adaptation investment in Australia and where it's needed, where we're best placing that capital, and in the way, that adaptation pathway that Zoe talked about, so that we don't have sort of maladaptation happening, but that we also do it in a widespread and systemic way. And part of that issue is that, a lot of these impacts are very local. There might be small scale projects that are needed, but if you're going to bring in institutional capital, it needs to be done at scale. Investors don't get out of bed for less than $50, $100 million. So how do you aggregate up those projects to be able to put together some sort of financing mechanism that you could look at those projects collectively? And, how do you derive a return on some of those projects, and who's willing to pay for it? There can be social measures and metrics which you can develop, but ultimately somebody has to be able to value that social return and be able to provide a financial return back to investors for it. So, we see that in other areas of impact investment. You might have a program that looks at reducing juvenile recidivism rates. The state government is willing to value that. They're willing to fund that because it saves on the cost of, juvenile justice programs. So it's an avoided cost on their front for which they're willing to pay for this investment. And you need a similar sort of thing for adaptation. So research into that is my answer. Would be interesting.
Thanks, Crystal. Do Chris or Ian have any reflections on that one?
If I can quickly jump in, I was just going to maybe ask a question back to Crystal and Zoe, and that is because the future is uncertain and the risks, value of avoided risk is never really known, because you either avoid it or you don't. And you can compare, if you don't avoid it, it's going to be this, and if you do avoid it, it's going to be that. So that's pretty easy. But across Australia or internationally, it's a shared cost. So when we talk about whether it's foundations or institutional investors, there's still, they're looking at it, potential investments, investment by investment, project by project. Whereas, so should, or do you think, Zoe and Crystal, that potentially avoided risks or, funding transition or resilience is actually more of a public investment concept, which then is, in Australia, maybe not getting the right discussion happening. And so actually then we have some of our, more progressive institutional investors actually trying to lead the charge, but actually we need to actually have, the public investment space to actually make the change at the same time as those institutional investors make the change as well.
I would say two things to that to start off with. I'm sure Crystal will have other views. The first is that the entire climate change problem in Australia, it could always be a public and a policy problem. You can go faster, you can be more coordinated, you can avoid maladaptation, you can avoid bubbles, you can avoid all sorts of stuff if you just do it centrally. That's always been the case. And it is absolutely the case that our progressive, and most of them are progressive these days, but that our investment universe, even our non-progressive investors, are having to try and find a way to do this without central support, and therefore having to build a whole bunch of additional governance and interaction infrastructure between themselves just in order to walk down the path that would be quite straightforward if we had policy. So that's always the case. But the other thing I would say is that this is, at some point, the institutional investment market and the private space is going to, will whether you do it via policy-led or via finance-led or company-led or whatever, at some point the private sector becomes a massive part of the conversation, because you need the private sector to make the right decisions across every single thing that they do. You need it to be every company, every new piece of infrastructure, every PPP, all of that needs to have a resilience overlay over the top of it. So you will, although it always makes sense to lead federally and to lead it centrally, you'll very quickly have to have some type of decision-making structure or standard or infrastructure that allows the private sector to make the right decision every single day in order to get the implementation that you need cross-system. Crystal, do you want to add?
Yeah, look, I agree. And I guess there are different types of adaptation investments that we might be talking about. So, I mean, one is people looking at the risk or climate risk for infrastructure and for buildings and things that they are going to be putting capital into, that they're going to be building. So investors are doing that, and we're developing, the mechanisms and the metrics and things for them to be able to do that and put that resilience and adaptation component on that. But where it becomes challenging is where you need adaptation investments specifically that might have a public good, but there isn't necessarily the public purse to pay for them. So how do you fund a seawall in a particular place that's going to have a public benefit? The local council, may not have the ability to fund that. They can't necessarily borrow money. They don't want to put it on their balance sheet. Can you bring in private sector capital and find a way to be able to finance that? Ultimately, the return on that investment might have to come from ratepayers. It might have to come from those taxpayers. But this isn't something that governments on their own are going to be able to fund. When we look at the level of adaptation globally that's needed, that $500 billion a year, that's more than government coffers alone can cough up.
Thank you, Crystal. I'm aware we're a little short on time, but I wanted to ask Ian, would you like to contribute to this last question before we wrap up?
Yes, just quickly to bring in another factor in this, and this is a discussion we've been having in the Pacific, is the whole issue of non-economic losses and how that is dealt with. And certainly Chris, I think, brought this up particularly, with the parallels in the Torres Strait Islands, where communities are suffering losses that don't necessarily have an economic value. It's loss of culture. For instance, in Tuvalu, people are losing their burial sites as a consequence of sea level rise and storm damage. And this is an issue. And clearly, this is not going to be easily addressed by private finance. We need, public finance to address those sorts of issues. Thank you.
Great. Thank you so much, Ian, and to the rest of our speakers for a lovely conversation. I think we could talk about this for the rest of the afternoon, but unfortunately we are out of time for this session. So thank you once again to all of our fantastic speakers for sharing your time and expertise with us today. We will reconvene in about 45 minutes at 1 p.m. Australian Eastern Standard Time for our next session on who does what and how. So thank you everyone so much, and we'll see you soon.